Imagine you could write off most of your investments the moment you make it. That's what many oil and gas investors do. Today, I want to show you a tax strategy that sounds almost too good to be true. Investing in oil and gas wells. This isn't a geology lesson. It's about how the tax code treats these investments and why that matters to your tax bill. So let's get started. Hey there, I'm Sammy Basa, your friendly fractional CFO. I help real estate entrepreneurs and small business owners keep more of the income they've worked so hard to earn. Think of two kids. One buys the lemonade stand and actually runs it. The other kid sits out a tip jar by the stand and just collects coins. So whenever someone buy a lemonade, the first kid is actually running the business. The second kid is just collecting coins. In tax terms, owning a working interest in an oil and gas well is like running the stand. It's treated as an active business. So certain losses can offset your W 2 or business income. And that's very different from most rental real estate, which is usually passive and cannot touch your salary or business profit. When a well gets drilled, money goes into two buckets. There are the disappearing items, things like labor, fuel, mud, chemicals. We call those intangible drilling costs. So those are generally deductible right away. Then there are the gear, equipment, things you can touch like pipes, casing, pumps, which get written off over time, similar to how you depreciate your truck. And once the well starts producing gas and oil, you also get a special break called depletion, which lets you shelter a slice of the revenue because the resource is being used up. So that combo, the fast deduction upfront, depreciation on equipment, and the ongoing depletion explain why oil and gas is a favorite of high income earner who want a legal deduction right away. When a well turns on, you start receiving monthly checks. Depletion helps make that income feel better after taxes because part of that is sheltered. Simple picture here is, let's say, big deduction upfront, the smaller deduction over time. So that check that can come monthly for years, it actually makes your taxes less and less every year. So here's a real example. One of our clients, he is owner operator of an S corp. He had very good, profitable, healthy year, over $500,000 of business profit, and he decided to invest $100,000 in an oil and gas. $75,000 of the $100,000 he had as an intangible deduction in the first year. So he got that $75,000 immediate deduction. Then he began receiving monthly checks once the will produced and used that ongoing tax benefit to help fund another project. So you can see the point here isn't to memorize a tax code, it's to recognize how this structure can turn taxes from pain into fuel your plan and produce future cash flow. Now, what if running the stand sounds scary? You still have another lane, it's called mineral rights. So with mineral rights, you're more like the jar kid. You don't pay operating costs, you collect a slice of the revenue from the production, and you still get depletion deduction on that income. It's usually simpler and lower risk, but you don't get those large upfront write-off. Working interest is more hands-on and higher risk, but it's where the powerful first year deduction live and where those deduction can offset active income when set up correctly. So who this really for? High earners with big W-2s or business income who want large legal deductions quickly and can handle some pumps and take some risks. Many offerings of oil and gas are private and often aimed at accredited investors. So it tends to fit people who already invest and can pass these checks. So before you write or sign up any deal or write the first dollar investment, do me a favor, always do a quick and real due diligence. So here's a list of things you can do. Confirm the structure in writing. Is it truly a working interest? Vet the operator tracking record in plain English. How many wells they have, where they are located, results versus forecasts. So what went wrong with the other prior losses and how did they correct it? Demand an itemized budget that separates intangible costs from equipment. If the numbers are vague or you feel rushed, sit back or walk away. So here's how to implement those investments without drama. Start with your advisors. Tell your CPA and attorney what's exactly your goal. You want a true working interest that's eligible for special tax treatment, and you want the entity set up so you don't accidentally block that treatment. Ask the sponsor for the offering document, the engineering summary, the line by line budget. Make sure intangible items and equipment are clearly separated, and ask how those costs are treated for tax reportings. You also want to clarify the timeline, when drilling happens and when costs hit the books, when first production is expected, and how monthly statement will flow to you. Get cluster clear on exit math on day one before you sign anything. Some of the tax benefits you enjoy early can be recaptured as ordinary income when you sell. So you want to plan the holding period and exit so no discovery or bad surprises later on. Finally, size your first deal like a test. Treat it like a small test. Start small, learn the reporting rhythm and how the cash flow work and the tax pieces, putting together. How does it behave in real life? How does it impact your total income for the year? Then you can scale into a portfolio if it fits. An effective oil and gas tax strategy can really be a powerful asset strategy when it executed properly. However, if it handled carelessly, it can really quickly lead to financial losses. So if you've got some substantial income and heavy tax bill, and you have some discipline, determination to do thorough diligence, oil and gas can turn today's taxes into tomorrow's cash flow. So bottom line here is oil and gas can be a truly powerful tool if you are the right person for it, someone with a high income, comfortable with some risk, willing to do real due diligence and set up with the correct structure, use the tool correctly, and it can be really meaningful to cut taxes and start a new stream of income. If used badly or incorrectly, it can really burn cash quickly and lead to financial disaster. So if that sounds good and I added some value, please hit subscribe. And I want to thank you so much for watching this video. I'll see you on the next time.
This has been another episode of our tax saving video series. If you enjoyed this video, please like it, subscribe below, and share with other business owners. You can find previous episodes and more information at www.bostacpa.com. Thanks for listening, and have a great day.